Everyone keeps asking the same question right now. If inflation is falling, if rate cuts are on the table, if tech has already ripped higher, then why do markets still feel broken, fragile, and confusing? Today, we are going straight to the source. Raoul Pal is one of the clearest macro thinkers in the game. Ex-hedge fund manager, founder of Global Macro Investor, founder of Real Vision, and early into crypto before most people had even heard the word. In this interview, he lays out a simple but uncomfortable answer. The problem is not earnings, it is not growth. It is not even hype. The problem is liquidity, the amount of money actually sloshing around the system. And once you understand how that liquidity cycle lines up with the business cycle, the election, and crypto into 2026, the whole mess suddenly looks like one of the biggest opportunities of our lifetime. In this video, we are going to break Raoul's framework into 4 parts: the liquidity air pocket everyone is feeling but nobody can explain, the K-shaped economy, and why Main Street still feels like a recession, why liquidity has not really arrived yet, even with ETFs live, and what this all means for crypto drawdowns, 2026, and the next real pain point. Let us start with what is actually happening right now under the surface. Right now, markets feel weak, jittery, and overreactive. Indices are not far from the highs, but every move feels like a mini crash. Crypto bleeds, tech suddenly wobbles. Everyone blames the AI bubble or overvaluation. Raoul says that is the wrong diagnosis. The core issue is a liquidity mismatch created by the government shutdown, the Treasury, QT, and the reverse repo drain all colliding at the same time. Here is how he explains it.
There seems to be quite a lot going on, but nobody can explain it. Where we are today, what day are we? We're on the 20th of November talking today, and markets puking. And it's been in that weak trend. I've been looking at this for a while, and there is this mismatch of liquidity that's happening at a macro level that's causing a lot of the issues we're seeing right now. And that is, without getting in too deeply into the weeds of it, basically, because of the government shutdown, the Treasury built up its general account and has not been able to really drain it yet. And there's no offsetting buffer because the reverse repo's drained and we've got QT going on. So we've got this kind of sucking of liquidity out of the system that really has affected the highest risk assets further out the curve, and crypto is that. Technology has been kind of volatile because of the same reason, but it's been held up somewhat by buybacks and also held up by the generally, I think 80% of all fund managers were below benchmark because they've missed tech, because all the way through they said tech's a bubble, AI's a bubble, AI's a bubble, and they've missed the whole move. And so that's dramatically affected performance. So they've been performance chasing, which kind of meant that NASDAQ outperformed for a period of time. But it's this liquidity thing. Liquidity, we found in our work at Global Macro Investor, using the total global liquidity explains 95% or 97% of NASDAQ's price movements over time since 2012 and 90% of Bitcoin's. So it is the single most dominant macro factor, and most of the explanations lie therein.
Yeah. Look, it's a great read. I mean, I want to go front and center. NVIDIA reported earnings. Jensen Huang is equally as important as Jerome Powell these days. They beat earnings. Expectation was 54, 55 billion. They came in at 57. Guidance for next year was very strong. Stocks down today. Question in investing is, how much are things priced in? Like the Mag 7, most managers, even though they may have been underperforming, it's been still a pretty good year for most folks. Are we just in a general deleveraging risk off cycle? People going into the holidays, they want to take profit, collect carry for the year? Or is there something else going on in a 2026? Is there a broader kind of macro concerns that you have?
So on the macro side, the business cycle, which is the main kind of driver of everything, has been very subdued for this entire cycle. And that's been driven by the high rates environment and the liquidity environment. If you, on a forward-looking basis, understanding all of the fiscal stimulus that's coming, plus liquidity stimulus that's coming, and the probability of rate cuts coming, the chances are the business cycle is going to be a lot stronger going into the election year. Don't forget, we've got Scott Bessent running the Treasury, who's an ex-hedge fund manager. He understands this game very well. So I think on a forward-looking basis, it looks great. But what you've got is this liquidity air pocket that means that there's not as much money around. So the people's propensity to take money off the table is higher. People are nervous. I mean, we've seen the fear index in equities be down at like 8, which
Mhm.
is insane considering the market's barely off the highs.
So the picture is pretty straightforward. The Treasury stuffed the TGA full of cash and has not fully drained it. Reverse repos are empty. QT is still pulling money out. There is no offsetting buffer. Result, the system is in a liquidity air pocket, and the far end of the risk spectrum is getting hit hardest. That is crypto, small caps, speculative tech. At the same time, positioning and psychology are stretched. Most fund managers spent a year calling AI a bubble. They missed the move. Now they are performance chasing, scared of losing what they just made, and hypersensitive to any wobble. So you get a strange mix. Fear readings at extreme levels, even though the market is barely off the highs. People quick to take money off the table. Every sell-off looks worse than it is because there just are not enough real buyers providing depth. The important point is this: Raoul is not saying the economy is collapsing. He is saying liquidity is temporarily tight. That is very different, and it sets up the rest of his thesis for 2025 and 2026. Before we go there, quick reminder: if you like deep macro breakdowns like this, hit subscribe so you do not miss the next Raoul, Lynn Alden, or Tom Lee video we put out. Now let us zoom out to the business cycle. On the surface, the headlines look fine. Unemployment low, GDP okay. Underneath, it feels like a grind. Restaurants, small businesses, and regular households still feel squeezed. Retail has not really come back to crypto. Most people do not feel rich from this cycle at all. Raoul argues that this is exactly what the business cycle data has been screaming for years: a K-shaped economy with hyperscalers booming at the top and Main Street stuck in the mud. Listen to how he connects this to 2026 and the election year.
There's 2 parts to this. One is how I'm personally positioned, and number 2 is how, let's say, the global macro investor or Real Vision Pro portfolio is positioned. I'm more risk seeking. I'm pretty much 100% crypto, and I'm comfortable with that. And I've been that way for years and years and years and years. So I don't really worry about that. But generally speaking, the portfolio has been split between crypto and tech since December 2022. So we managed to get most of the lows or around the kind of lows period and have held those positions through and through, adding in stuff like solar and a few other themes within it. And because I'm a business cycle investor, that's how I think about it. I won't really change that until I see the business cycle peaking out. And that's generally how it's worked for me over time, is extending your time horizon actually increases your returns, as opposed to, worrying about the next 3 months, 6 months, unless you're hitting a cycle peak or top or bottom.
Going back to the business cycle that you keep talking about, you hear earnings from companies outside of the AI space, Chipotle's of the world, that give you a good read on what's happening in Main Street. It's not great. Sentiment's not great, and fundamentals there are not showing up. How does that compute in your thinking?
It's exactly what the ISM is telling us. The ISM survey has been below 50 the entire cycle. It's the lowest, it's the longest period of below 50 ISM. So that's no real economic expansion in history now. And so that is exactly the K-shaped recovery, because what we've got is this massive CapEx boom going on in the hyperscalers and the AI space, some government spending, and then other than that, the economy is pretty flat. So you're seeing it everywhere. You know it from everywhere. It's one of the reasons why retail haven't come in crypto, because they don't have any disposable income. Real wages are still pretty low. Economic activity for most businesses is not great. And this is the thing that Scott Bessent's been talking about, is how do you increase Main Street activity? And that is what has to happen. That's the rate cuts. That's taking taxes away, not paying taxes on tips and things that run the basic services and the basic economy of what most people live in. So, I think the read of, Chipotle or whatever is dead right. And that is what I think the Trump administration will focus on to try and get the midterms through.
There are a few key points here. First, the ISM has been below 50 almost the entire cycle. That is historically unusual. It confirms what people feel. No broad-based expansion, just a narrow boom in AI capex and government spending. Second, if Main Street is flat, retail has no spare cash. That explains why crypto adoption feels slow, why smaller businesses are struggling, and why sentiment feels much worse than the top-line data. Third, the policy response is almost baked into the cake. The new Treasury leadership understands markets. A Trump administration will be laser focused on Main Street into the midterms. That means rate cuts, looser financial conditions, tax tweaks, and targeted support to the real economy. You do not have to like the politics. You only have to understand the incentives. Election year plus weak Main Street plus a liquidity-focused Treasury is a recipe for easier policy and more money flowing into the system, not less. Which leads to the next part of Raoul's thesis. If liquidity explains around 90% of Bitcoin and Nasdaq price action, then the key question is simple. Where is total liquidity going next? From the outside, it looks like crypto already had its run. Bitcoin hit fresh highs, ETFs launched, big names came in, traders got excited. Then the party kind of fizzled, prices stalled or fell, volumes faded. If liquidity is supposedly the main driver, people ask, how did we get spot ETFs, institutional adoption, and still end up with meh price action? Raoul's answer is brutal and simple. Overall liquidity this cycle has been weaker than previous ones, and ETF flows are far more complex than people realize. Here is how he breaks it down.
Well, because my thesis is entirely built on liquidity and network adoption. So that is what I'm always testing. So, is something wrong with that thesis? And the variability around the correlation to liquidity is driven by these other factors. Who's the buyer, who's the seller, and why, basically. So I concern myself less with that and more observational when it comes to that. But the real question is the thesis right about liquidity? Because if that explains 90% of the price movement of Bitcoin, I need to get that right because it's the single most dominant factor we've ever had in financial markets. So that's why I spend all of my time thinking about that. And then you overlay on top is my asset allocation right? I.e., is the network that I'm betting on or the token I'm betting on, is it having the growth that I'm expecting from it? Because if not, you need to have a serious conversation with yourself about, do you have a bag holder bias? Do you have all of those things? So really, I spend my entire time testing those two hypotheses. Is my asset allocation right? And my allocation to the asset class right, which is based on the liquidity thesis.
Yeah. On that double clicking, look, ETFs have been a huge liquidity influx. It's slowed down, essentially when we saw that huge sell off in October, you saw massive outflows. Does that, you had record, you had a lot of ETF flows coming in. Bitcoin hits an all-time high. It's down to, off its high. Particularly Ethereum has struggled, even though you've had an ETF, even though you have the Tom Lees of the world really go out there and raise billions of dollars. Do you sit there and say, gosh, like we couldn't even hit all-time highs. We couldn't really break past that for Ethereum. And, even with this, new mechanism of an ETF. And do you sit there and question, maybe there's something else here that, again, liquidity is there, but prices are not moving in the direction that you want?
So again, liquidity has been relatively lackluster so far this cycle versus every other cycle. And that's given us relatively lackluster prices. So I don't really have an issue with that. If I overlay US total liquidity on total market cap of crypto minus Bitcoin, it's pretty much identical. So it's telling us liquidity has not gone to new highs yet, so crypto hasn't gone to new highs. And that's total liquidity, not rate of change. So, yeah, I don't really, it's not something that's concerning me in that respect, I think.
Yeah.
And also people don't realize that enormous amounts of those ETFs is actually just arbitrages. So they hold the spot and sell the semi futures. Some are doing the perps, not many do the perps, but that trade is gigantic. And that's where a lot of the volume comes from. So the total actual buying by institutions and retail, significant. But again, if we go back to the business cycle, people's free cash flows in the normal world outside of tech have not been great yet.
Right.
And so therefore you can't recycle those cash flows into markets. And so if my thesis on the business cycle is right, we'll see that rise significantly. If it's wrong, we won't.
So a few things to unpack. Raoul's entire framework is built on two pillars, liquidity and network adoption. He keeps stress testing both. Right now, total US liquidity still has not made new highs. When he overlays that on total crypto market cap x Bitcoin, the chart basically matches. No new liquidity peak, no sustained new highs in crypto. That is the core relationship. ETFs have helped, but they are not pure new money. A big slice of ETF volume is just arbitrage. Funds buy spot, short futures or perps, capture a spread, and recycle capital. That adds turnover, but not as much net ownership as people think. At the same time, real-world cash flows are tight. Family offices are still stuck in old VC vintages. Hedge fund capital raising is slow. Households outside the tech bubble have weak excess savings. If you do not have surplus cash, you cannot shovel it into Bitcoin, ETH, or growth stocks, no matter how bullish you are. The important part is the forward view. If Raoul is right about easier financial conditions, rate cuts, and Main Street support into the election, then liquidity should finally break higher after this air pocket. That is when his liquidity model says crypto can make real new highs, not just retests. Which brings us to the question everyone cares about. What does that mean for drawdowns and timing? Every crypto investor has the same fear in the back of their mind. What if this is already the top? What if we are about to relive another 80% drawdown? What if the 4-year halving cycle is destiny and we are just replaying 2018 again? Raoul thinks that framing is wrong. He believes the real driver is not the halving. It is the global liquidity and debt refinancing cycle. Here is how he explains where we are now and where the real pain is likely to show up next.
Bitcoin is crypto is the most affected by liquidity of all of the risk spectrum of assets. So it tends to go down. It's also an earlier stage, network adoption model, like Amazon went down 95% in its first cycle, stuff like that. Over time, networks as they get adopted have less volatility because there's more economic activity and less, and it tends to be stickier over time. So my guess is the next time we have the liquidity down cycle, which I think is more likely to be 2027, we will see less of a drawdown in Bitcoin than it was previous cycle. And we've seen that pretty much every cycle, that it's had less of a drawdown. My first cycle, I think Bitcoin was down 87.5% back in 2013. And then it was down less in the next cycle in 2018, whatever. So it kind of fits to me that over time, but when you go further out the risk curve, so if you've got a newer token that's smaller, it's going to fall 90%, as they always do. So I don't think that changes anytime soon. It's just the question is, are we starting it now, which is what some people think, because they think that the 4-year cycle in crypto is the most dominant factor. And I would say, no, it's driven by the debt refinancing cycle. So it's just two different ways of looking at it. And, from what I can see, we've got 10 trillion of debt to roll over the next 12 months. If you're rolling 10 trillion of debt, you're going to need some liquidity to do it. So in which case it's hard for the market to go down.
What you're saying is it's a business cycle. Don't overcomplicate it. If you believe that's going to continue to be strong, crypto should continue to be strong. And so
at basic level, yeah. If the business cycle's okay, crypto's going to be okay. And if they're tightening conditions, the Fed usually tell you, like, we're going to tighten rates. It's usually a pretty good flag that liquidity is going to come out of the system. So, you can keep it as simple as that.
There are a few big takeaways here. First, the huge drawdowns are a feature of young networks tightly linked to liquidity. As the network matures, volatility shrinks. Each cycle has seen smaller percentage crashes in Bitcoin. That is what you would expect from a larger, more liquid asset with deeper adoption. Second, the key driver of those big down cycles is the liquidity cycle, not the halving date. When rates rise and liquidity is drained, risk assets get hit. When liquidity expands, they rip. We are not in a tightening phase right now. We are heading toward cuts with a giant wall of debt that needs refinancing. Raoul puts a number on it, around 10 trillion of debt rolling in the next 12 months. You do not refinance that kind of stack by starving the system of cash. You need liquidity. That is why he thinks the next real liquidity down cycle, and therefore the next brutal crypto drawdown, is more likely to land around 2027 rather than right now. Third, the practical implication. If the business cycle is okay, crypto is okay. If financial conditions are easing, liquidity is coming, and policymakers are trying to juice Main Street into an election, that is not usually when you get the big 80% washout. You still get corrections, vicious pullbacks, and scary headlines. But in Raoul's framework, those are dips inside a secular uptrend driven by expanding liquidity, not the start of a multi-year winter. Which leads to the final point of the video. If you strip Raoul's framework down to its core, it is incredibly simple. Track the business cycle, track liquidity, track network adoption. Right now, the business cycle has been weak and K-shaped, but policy incentives are lining up for a push into Main Street. Liquidity is temporarily tight thanks to the T, GA, QT, and the shutdown hangover. but forward indicators and political pressure point to easing into the election. Crypto is still highly sensitive to liquidity and still early in its institutional adoption cycle. Put that together and you get an environment that feels awful in the short term, but sets up something powerful into 2026. Raoul is not pretending this will be smooth. There will be fierce spikes, forced sellers, broken structures like some of the DATs, and a lot of noise. The market almost never gives you a straight line, but zoom out and his message is clear. This intersection of AI, digital networks, liquidity cycles, and crypto is one of the greatest macro trades of our lifetime. And in his view, it is not finished. The real terminal pain probably comes in the next liquidity down cycle, not today. Your job as an investor is not to predict every tick. It is to understand the cycle you are in, position for the big drivers, and avoid blowing yourself up on leverage and overexposure while the thesis plays out. If Raoul is right, the real risk here is not missing the top. It is underestimating how big this secular trend can get when liquidity finally lines up with adoption into 2026. That is it for this breakdown. See you all in the next one.